We get a late day rally on Wall Street, but the indexes really haven't gone anywhere for the better part of a week. As a matter of fact, since the Fed issued their announcement last Wednesday, stocks are very little changed. This, of course, raises an important question for the markets as we enter what is both a low liquidity period globally around the Easter holiday, and also, uncharacteristically, the week's key event risk, where markets won't have an exit if things go wrong. Welcome. This is Macro Money. I'm Ilya Spivak, head of Global Macro here at tastylive. And this is the key question that we're going to ask ourselves today. Why is the price action doing what it's doing? What is this event risk facing us in the coming days? What could it do? And what are investors to make of it if they can't do anything when the outcome actually hits? So, if we consider first and foremost the kind of lead that we got from the markets when we looked at them at the end of last week, the picture seems relatively straightforward. So we can see here on the week, the performance is about as you might expect. Why would you expect it? Well, let's take a look at what the Fed actually told us on Wednesday last week with their announcement. Here's the summary of economic projections. The actual policy statement was almost unchanged. And what we have then here is in the yellow, those numbers that were basically left static, and in the green, those numbers that were upgraded. Notice there's nothing else here in red. There were no downgrades to speak of. So GDP upgraded for all 3 years of the forecast. Unemployment, either better, that is lower, or steady. Inflation, either steady or higher. For the headline, same thing for the core. Probably the most eye-catching bit here is that for this coming year, the near-term view for 2024, stronger growth, lower unemployment, and higher to neutral inflation. Neutral at the headline, but of course, much more significantly higher at the core, which is the thing the Fed is most concerned with. We'll take a look in a moment why. What that then distills into, one might think, is a higher view on rates. But the Fed clearly is not of that mind. As we can see here, the Fed funds projection unchanged, 4.6%. If the current median rate, the Fed, of course, sets their policy rates in a range, so we're currently in a range for the target of 5.25 to 5.5. The median is 5.33. What that means is that the Fed was calling for 80 basis points in cuts, give or take, before this announcement and after. So in December, they said the rate's going to be 4.6. Now in March, they've said the rate's going to be 4.6, even as inflation and growth expectations went up. In other words, the Fed is saying we are not so data sensitive as to move the needle even as we make these upgrades. Not surprisingly, then, stocks like it. They go up. Bonds like it. Yields don't like it. They go down. Crude oil continues to march to the beat of its own drum, but there things start to get a little weird. The dollar is stronger. Gold is steady. Bitcoin is down. But at least the core take in stocks and bonds is what you might expect. But then things become complicated. Here's market performance since the Fed made its pronouncement. Stocks are unchanged. They have moved barely at all in the days after the Fed announcement. The announcement was on the 20th. This is from the 21st through to today. S&P 500 barely changed. NASDAQ barely changed. Gold barely changed. The dollar is stronger. Bitcoin is a touch higher. Although 2.3% in Bitcoin land is hardly a move. And the configuration on bond yields is a bit odd when you consider what the Fed lead has been. Yields are, of course, down across maturities, but what we see here is that the long end is down far more than the short end. And if the markets were adjusting to a more dovish near-term policy view coming out of the Fed, well, then we might expect that it would be the front end that would be falling, leading on the downside. But no. Instead, there seems to be a flow into longer dated bonds, which seems all the more interesting when we consider that what the Fed did here was not just keep the current outlook steady, but also increase the longer run projection right here. So what you might expect here is actually bonds at the long end to do less well, because you would expect those yields to now be pinned at a higher level, longer run. And indeed, if you were looking at the weekly performance, that's sort of what you saw. The short end moved more than the long end. And if we looked at the 30-year, it moved even less. It fell even less. Which makes this configuration seem somewhat odd. Now, perhaps this is digestive in the absence of further news, but certainly if the market was enjoying a dovish lead from the Fed's perspective, it couldn't enjoy it even 24 hours after the Fed announcement and hasn't moved in that direction since. Gold might be expected to have performed well. The dollar might have expected to decline. That's not what's going on here. Now, if we take a look at how Fed policy expectations have evolved since that Fed announcement, what we find is there has been a significant hawkish shift in policy, thanks in part to the very economic data flow that had the Fed upgrading growth, inflation expectations, as we just saw. So from January, that January 31 meeting, up through the Fed meeting last week on the 20th, we can see a significant hawkish adjustment. Rates now meaningfully higher, basically across the entire forecast for the year. But between the policy announcement last week and today, we can barely see the change. That dotted line for the Fed announcement kind of peaks out a little, but things are at standstill. And what we find is that if we look at how these things have evolved, that standstill coincides with the market landing squarely on the Fed's policy projection. So consider here that looking at what has catalyzed the stocks rally since it began in late October, early November, the initial start coincides right along with the beginnings of a dovish shift in Fed policy expectations. As you get more rate cuts being baked in, as the Fed comes out at the beginning of November and signals we are done hiking, and now the view is to cut, the market starts to speculate, well, how many cuts? And they ultimately arrive at almost 6, 7 here. Now, when the Fed actually comes out in late December and says, okay, here's a baseline for how many cuts. We see rates at 4.6 at the end of the year, so we're looking for 3 cuts. Here's that line right here. You can see it's pretty much exactly at 75 basis points. If we do the math here, 5.33 minus 4.6 gives you 73 basis points. So 2 basis points off from exactly 3 cuts, which is a glorified rounding error. So looking at all of that, the markets reasonably reckon, okay, well, we think that it's going to be this many cuts. Fed thinks it's going to be this many. Obviously, we're right, or we wouldn't be baking this in. Money's going to be cheaper in the future. Keep going. Notice, by the way, that as this anchors, the rally anchors until the Fed gives this update, and then the rally can restart because there is now a wider gap here. The market is almost twice as dovish as the Fed is. Then, of course, we get that run of good economic data. We can see here, this is the City Economic Surprise Index, and we can see here data increasingly outperforming relative to forecasts. That's what catalyzed the Fed's adjustment of those expectations. That's how we end up shedding rate cuts here until finally we arrive exactly where the Fed was saying in December and where it has now reiterated we are last week. And so what we've seen is this hawkish adjustment in the policy outlook. This is rate cuts going away relative even to January. But now the object of speculation has ostensibly been exhausted. And the markets understandably are asking, okay, well, if the driver here was cheaper money in the future, well, that driver is no more. Now what? Well, this week, the next shoe to drop in this story comes to us on Friday when the market is actually closed. And there will be nothing for investors to do by way of a reaction, making for an interesting set of circumstances where the market most needs a catalyst at a time when that catalyst can't have confirmation through price action. The first thing that's on the menu here is going to be the PCE inflation report. This is the Fed's favored inflation gauge, and we can see here expectation is at the core. We're going to stay unchanged at 2.8%. year on year. For the headline, we're going to tick up slightly from 2.4 to 2.5%. If we look at the makeup here, clearly the last remaining bastions of what has kept inflation up here are housing and core services. So services excluding energy and excluding food and excluding housing. We can see that food inflation has been squeezed to next to nothing. Energy is now a disinflationary force on the overall and a deflationary force on to itself. It's in negative territory here. So too is the core goods side of the equation. So really the story here exists in this big purple area in the middle. But of course, the Fed has just told us that they don't see unemployment coming down in a hurry. And what's going on in this purple area is primarily about locked in wages. So the question then becomes, what's this data really going to do to move the needle? Perhaps not very much. If the Fed is going to say we can improve growth and we can improve inflation forecasts and we can improve the unemployment rate view and still keep to 3 cuts, there doesn't seem like there's very much that could happen to these numbers from at least the Fed's own perspective to really change the game. Now, when the CPI version of this came out, same month, and the calculation here is a little bit different as far as the basket, we saw upside surprises. The headline came in at 3.2 versus 3.1, the core at 3.8 versus 3.7, and the markets didn't like it. But that was before the Fed made their announcement. So going into the PCE report, we already know that there's a slight skew toward upside surprises from CPI, and we also know that the Fed isn't going to do anything with that upward skew because they had that opportunity in these forecasts and didn't take it. We know that economic growth has steadied, and there's not really much to do there. If we look at the latest PMI numbers, we can see manufacturing, services, and of course, following from that, the composite, not falling, but not accelerating. Flatlined for 3 months now at about a steady clip. So the economy isn't giving us much of a lead, and this data isn't likely to show us anything that ought to be shaping the Fed's reaction function. There's also a speech from Fed Chair Jerome Powell, also on Friday. He'll be speaking virtually with the San Francisco Fed. And we have, again, a question of which part of that guidance, which in Powell's case is tilted a little bit dovish, is likely to change the narrative. From a stocks perspective, neither seem likely to really change the game, but the response from price action since the status quo that's likely to get reinforced here has been established is there are no more catalysts to go. Now, does that mean that the market won't find a new catalyst? Certainly not. It could. But since there is no trading the news itself with the markets being closed, it seems unlikely that there is significant headway that's made in the interim. Meanwhile, the market still needs a reason to go higher, and so far doesn't seem to be finding it. Where there is perhaps some opportunity is in the currencies space, where we can see the anchoring of the Fed outlook has been mirrored by the anchoring of the US dollar, as well as the Japanese yen. So if in fact the Fed outlook is at stasis, well, then the yen might be out of reasons to keep going down because the yield differential has stopped moving against it. And the dollar might finally look like it has room to advance as other economies catch up to where the Fed is in a dovish direction. So at least the end of speculation for the dollar looks like a bit of an improved relative perspective. But what all this means for stocks remains an open question. What we do know is they haven't found a reason to be happy yet. And that is macro money for today. As ever, we are here Monday through Thursday, right after overtime, a show that I co-host with Dylan Radigan and Chris Vecchio, looking at the Wall Street close and what is likely to happen thereafter. I'm back on with Chris for Futures Power Hour on Fridays, just not this week because of the holiday. On with Victor and Tom for First Call on Sundays. Writing for the News and Insights portion of tastylive.com. And opining sporadically on the platform formerly known as Twitter at Ilya Spivak. Thanks very much for watching. See you tomorrow.